If you're just joining us, busy morning with the Lehman news, chatting with hedge fund manager Bill Ackman of Pershing Square, and Nouriel Roubini, our guest host this morning. I want to talk about something beyond Lehman, and those are the bets you've made so far this year, last couple of years that have gone well. What are you sticking with? What are you changing?
Actually, I very rarely like to make stock recommendations, but I won't call it a stock recommendation. I'll point out an interesting opportunity. Longs Drugs. Longs Drugs is trading at a nickel above a cash tender offer that CVS is holding open to acquire the company. Under the terms of the deal, the tender offer has to remain open until August of 2009, or they get a two-thirds vote, a two-thirds tender from the people who own the stock. The company can continue to pay a 14-cent dividend. So you're getting paid to wait. Now, we bought a stake in Longs Drugs because of our view that this was a company that reached the end of its strategic life. It had an incredible market position in California and Hawaii. It owned a PBM that was undervalued. It had a big opportunity to expand margins, and it was a asset that we thought CVS, Walgreens, Walmart, others would be very interested in acquiring.
Right.
Actually, there's a story in the paper today about Walmart having this, competing with Tesco in California for a small store concept. Again, I think they're likely buyers. Now, it's never happened to me before. While we were buying it, boom, we wake up one morning. We filed a 13D, and a week later, CVS announces the deal to acquire the company. We learned from the tender offer materials the company was never shopped. Walgreens expressed, or Party A, which everyone believes to be Walgreens, expressed interest in acquiring the company at 70 a share. Never got due diligence information to do their work. Took a little longer than CEO would like. CEO picked up the phone, called CVS. CVS came in at $71.50, and they sold the company. Part of the reason, in my view, why they rushed to sell the company is we filed a 13D, and a lot of management teams and boards don't like to look like they were pushed into something by a shareholder activist. So there's no reason to rush into a sale. This is the ideal competitive auction. But the board did something quite good, and their lawyers did something quite good, the way they structured the deal. I don't think I've ever seen a tender offer which has to be kept open for a year. So if you pay $71.55, you're paying a nickel for an 11-month call option, okay, minus the 14 cents in dividends you're going to get over the next. You got 3 more dividends, I think, that you're going to get. We hired Blackstone. We're working very hard to do the work that properly should have been done in terms of running an auction. We're getting some traction, and your downside $71.50 plus dividends. So I think it's a pretty interesting.
CVS is a $52 billion company, and there's $2.5 billion. They could write a check for this, right?
Sure. We think the values here. The real estate values alone, we think, are in the high $2.9 billion. Basically, the price they're paying, they're getting the retailer and the PBM for free. So, we think values here are, as high as $90, $95 a share. Your downside's a nickel, but you get dividends. That's the best opportunity I know. There are no outs in the agreement other than material adverse change particular to longs. And we think, drug business, not the drug business as a whole. If it affects longs in particular, then, but I think it's a very, very good risk reward.
LDG. All right.